Welcome everybody to today's information session called Is It All Worth It? Do I stay open, close for good, or restructure? I'm Louisa Siderbat from Vincents, and we are today going to approach the topic that for many is the elephant in the room. It's something that we sometimes wonder about, but sometimes it's too scary to go there and even think through what could happen. Because it'll be so different from our day-to-day, everyday life at the moment with our business. So what we want to do is take some of the fear away today, equip you guys with knowledge, because you guys are business people. You know how to make a good decision once you have the knowledge. So when we equip you with the knowledge, it becomes a whole lot less scary, and you can begin to evaluate and apply that good business sense that you have as to what's best for you. So for today, your hosts are myself, Louisa Siderbat, Henry McKenna, and Andrew Whitaker from my team here at Vincents. We all work with companies and people who are facing very challenging financial situations and help walk people through what their options are and what they can do. We also have the honour of having Wes Lambert, the CEO of Restaurant and Catering Industry Association, with us on today's call. Thank you very much all for being here. All right, so let's get started. Today we'll be covering quite a few different topics all around this area about how do we even decide if we're going to stay open or close down? What should we be thinking about if we are going to be staying open? Can we strike a deal with our creditors? We're going to look at a case study. We're also going to have a look at the process if we have to close down. We're going to look at the all-important topic of asset protection to protect yourself, whether you're staying open or closing down. Looking at how we work with companies and businesses to help them through times like this. Answering your questions. We'll answer your questions at every stage as we go through the presentation. So please feel free to put those in the chat box, and I believe they're confidential and anonymous. And at the end, we'll also have a market update from Wes. All right, let's get into it. So the question, which is actually quite hard to grapple with, and many people wonder, even though it's a scary place to go in our minds, is it worth keeping this business open, or do I need to close it down? So here are some things to help us work through this question, and some factors or criteria, for want of a better description, as to how to help us decide. So firstly, there's the financial position, or what's happening financially currently in the business. Now, with a lot of businesses closed around New South Wales and Victoria, the current financial position might be we're at 0% revenue. Or if you're open for takeaway, it might be, 30% revenue or 50% revenue of what you were doing pre-COVID. However, your expenses might not be 0% or 30% or 50% of what's currently happening. So looking at what's happening currently. Now, in addition to what's happening currently, we also want to look at the next circle, which is what's likely to happen in the future. So just say for whatever reason your business is going along kind of okay, not great, but not too dire, maybe breaking even. What's the situation and landscape looking like in the future? So that is, okay, there is an environment of uncertainty, and these lockdowns, not out of lockdown, it's so hard for business owners to plan right now. You can buy stock and fresh supplies and things like that, and by the end of the week you can't use them because we're in a lockdown and the volume just isn't there. It's extraordinarily hard. And we're also looking at future commitments. So just say if we've put, say, rent on a payment plan or it's deferred, what does that look like into the future as financial commitments? Now, that's all. These are things that you can work through either yourself or with your accountant or bookkeeper or somebody like us, but they're all the numbers side. But as we know, a business is more than just numbers. It involves you, the business owner, or the group, the business owner. People are important in this. And this is the element of business and a holistic view that often gets forgotten. How's your mental health going? Has this turned from, a dream into a nightmare? Has it turned into something that's all-consuming? Are you up at 3 a.m. wondering what you're going to say to the landlord's solicitor or something like that? Because that's not good for you. And we like to remember that you are a very key part of this, especially in small and medium-sized businesses and groups. You are important, even if governments or other people have maybe not provided all the support or acknowledgement or recognition. Where you are mentally is important in the decision of how this is going. The next circle is similar, but with a more future focus. What do you want? Because it's all fine if the numbers say, look, you could scrape by, you could make this work. But if you're over it and you would rather not have the stress and not carry it into the future, that is actually an important consideration in this decision. What do you want for your future? Do you just need a break and you just need some time with your family? Do you want to go do something else? Or do you want to give this a go? Is there still enough there that you want to do this? That is a totally valid and important consideration. Now, sometimes from looking at those 4 factors, there's a very clear answer that's apparent. Sometimes none of it works out and it's a clear answer of no, this is not going anywhere. It's not good now and it's not going to look good in the future. I don't want to be here. I just need some time off and just to regain a normal life again. Sometimes it's very clear. Other times it's very clear in the other direction, as in, yes, we're managing to get good compromise deals. Yes, we can do this cash flow in the future. When part of the industry that might be slightly less affected, you might be suburban rather than CBD or so many different other factors. And this is okay, I can do this. So sometimes a yes answer falls out and sometimes a no answer falls out. Sometimes, though, it's a bit of a mixed bag and it becomes, all right, some factors say I could, some factors say I couldn't. This bit's going well, but, maybe landlords is an issue, or maybe landlords is going fine, but suppliers or staffing is an issue. So it might be a bit of a mixed bag. If you end up with a bit of a mixed bag scenario, one of the things to consider is maybe the answer is actually somewhere in between. Something like a restructure where you might keep the good bits and ditch the not so good bits. And we'll cover that a little bit more later in this presentation. But this is a good summary that some people might like to keep and reflect on if it assists. So I'll now hand over to Andrew from my team.
Thanks, Louisa. So staying open, if you've arrived at this decision, then that's great. But it's important to know that just because you've arrived at this decision doesn't mean that the future won't be choppy. I'm sure that most of you have heard this saying, hope for the best, but plan for the worst. We think your approach here should really be about the numbers. If you're comfortable with the numbers, then that's great. But if you're not, book an appointment with your accountant or someone who can walk you through the numbers. You need to know the sizable expenses and balances and potential future costs that could make you vulnerable. It's a watch and monitor situation, basically. You should have a cash flow forecast and continue to monitor and update it each week, looking at the different assumptions that you've made about the future and checking to make sure that those are still applicable and realistic. You need to understand what your current debt amount is across your business and consider what it will be in 1 to 3 months. And at what point does that debt start reducing faster than it's accumulating? What costs do you need to be paying each week? What can you avoid paying? You need to know the numbers, even if you're not the person that does the mechanics behind them. Another important thing is, do you know at what point you break even? What's important to note is that trading conditions have changed considerably for the vast majority of hospitality business owners. So if you have a pre-COVID break-even point, have you reworked that calculation based on your new and unique set of circumstances? Another fundamental part of planning for the future and planning for the worst is risk analysis. This means looking at your business holistically and what risks you have and how you might mitigate those risks. An obvious risk associated with a lot of hospitality businesses at the moment is landlords. But something less obvious could be suppliers. What if one of your critical suppliers stopped supplying to you because your account was too risky for them? Do you have a plan B? Before I was an accountant, I had a business distributing baked goods to cafes in Brisbane, and our main supplier fell over. And I hadn't thought of that as a possibility until it actually happened, which meant that the business had to effectively cease trading until I came up with a solution. What we want you to consider here is that you don't want to be sideswiped from an angle that you haven't considered or thought about. Another vulnerability could be around staff. It's hard to find staff. Is there a plan to deal with that in place? Currently, there are geographical boundaries where staff can only move within certain areas, and that might be impacting you. These are the kind of questions that need to be asked and answered so that your business isn't handicapped by each of these different scenarios. And it's important to note that each business will have totally unique risks associated. Another part of risk analysis is to look at your business's structure, who the directors are, and whether they've given any personal guarantees. But Louisa will talk about that more later. The second thing to action is around leases and locations. You've probably thought about this to death, and it may possibly be your number one stress and vulnerability. You've probably already considered, do I keep some sites open? Do I close some? Can you renegotiate? There are special lease negotiators in the market that can help you get the most out of a lease negotiation. For some of you, your leases might be coming up for renewal. How are those negotiations going? Earlier this year, we surveyed 84 businesses located within the Sydney CBD and immediate surrounds, and 74% of them had entered into negotiations with their landlords. But only 44% of respondents considered those negotiations or considered that the agreement reached in those negotiations to be fair, and only 30% of respondents thought that their premises lease was at a market rate. To put the issues we're seeing faced by business owners into context, we've been talking to a restaurant located in Melbourne, and it was offered a 60% removal of its legacy debt if it paid 40% of its rent upfront on renewal. Now, this is a pretty unusual situation and offer, particularly because the landlord is Westfield. But how are you meant to come up with 40% upfront if you're closed in the Melbourne CBD? Some people are being done to death by their landlords. Some landlords won't budge an inch, and some are putting arbitrary offers on the table that you basically have to saw your own arm off to accept. The third thing to put into action is asset protection. It's important to know what things are like now and to consider asset protection while they're still okay, because asset protection is a lot harder when things are dire, and it can be too late by then. But Louisa will discuss that a little bit later as well. So I will now pass on to our next presenter.
Thanks, Andy. My name is Henry McKenna. Thanks for joining us here today. So I'm going to look at the possibility of striking a deal with your creditors. So you may have a good business that, for whatever reason, has accumulated a lot of debt, or it could be it has onerous contracts or leases that make an otherwise profitable enterprise loss-making. For example, we recently looked at a health food retailer that had 42 stores where 16 of the stores were very profitable, but the other 26 stores were loss-making. Where there's a fundamentally good business, there are opportunities to restructure a business, both operationally and financially, and save it. Although this is more likely to be achieved if steps are taken early rather than waiting until the only real option left is to close down the business. So restructures can be done either formally or informally. A formal restructure involves the appointment of an external administrator to the entities that trade the business, and I'll discuss that in more detail shortly. An informal restructure doesn't involve the appointment of an external administrator, and it basically involves talking with the business's key creditors and suppliers and cutting deals or renegotiating agreements to make the business profitable again. These negotiations usually start with the frank admission that if things don't change, the business will need to close and that everyone will suffer a loss. If there are just a few suppliers to the business and there are good relationships, then exploring an informal restructure is a good first step. I should also add that the tax office will not renegotiate debt in this way, although it may waive interest and penalties if the underlying debt is paid in full. So if an informal structure isn't possible, what's the formal restructure option? Well, the main one used is the appointment of a voluntary administrator to the business's trading entities. As the name suggests, it's a voluntary step taken by the company's directors, although in some circumstances it can also be done by the company's secured creditors. So the primary objective of voluntary administration is to maximise the chances of the company, or as much as possible of its business, to continue in existence. Then, if that isn't possible, to get a better return for the company's creditors and members than would result from an immediate winding up of the company. An administration typically runs for only about 6 or 7 weeks, although the time frame can be extended if needed by the administrator or the court. In an administration, once it starts, control of the company and the business moves to the administrator, who has the power to do pretty much anything with it. They can continue to trade, cease trading, terminate employees, disclaim onerous contracts and leases, sell the business, and a whole lot of other stuff. The administrator isn't acting on behalf of the directors who appointed him or her. They're acting in the best interest of all stakeholders in the business. This will include its creditors and suppliers, its employees, and its shareholders. As well as looking after the business, the administrator will investigate the company's affairs and work with anyone who wants to put forward what's called a deed of company arrangement, or DOCA. And a DOCA is effectively a proposal put to creditors which will usually see them getting a better outcome than they'd get if they vote for the alternative, which in most cases is that the business is shut down and the company that trades it is wound up, or in other words, liquidated. Towards the end of the administration period, the administrator sends creditors a report which details the findings of their investigations, details of any DOCA proposal they've received, and it includes an opinion by the administrator about what they consider to be in the best interest of creditors. A meeting of the company's creditors is then held and creditors get to vote on the company's future. And there are 3 mutually exclusive options. Firstly, the administration ends and the control of the company and the business passes back to the company's directors, although this rarely happens. I've only seen it once in my 20 plus years of practicing. The other option is that the DOCA proposal is accepted by creditors. And the third option is that the company is placed into liquidation. Whatever is voted on by the majority of creditors will then be binding on all creditors, with the exception of secured creditors. And I'll give you an example of a DOCA on the next slide. Another option recently made available because of the impact of COVID-19 on small businesses is a small business restructuring. This is similar to a voluntary administration, but it's typically a faster process, usually only about 5 weeks. And control of the business stays with the company's directors while a proposal is put to creditors. Under this type of external administration, if creditors don't agree to the proposal, the company doesn't automatically go into liquidation, although that's probably where it will end up, as the small business restructuring process is only supposed to be used by company directors when the company is considered to be insolvent. There are also some eligibility requirements to be able to qualify for the small business restructuring process. And the key ones are that creditors are collectively owed no more than $1 million. All tax lodgements are up to date. All employee entitlements that are owing are paid up to date, and that includes superannuation. And the companies and directors involved have not previously been through this process before within the last 7 years. So I'll now talk you through a theoretical case study, but one which is based on an ongoing matter where I was appointed as a voluntary administrator in 2019, and I'm now the deed administrator. So the business on appointment operated 19 restaurants across 4 states, but the majority were in Victoria and Western Australia. The business was traded from 5 corporate entities due to legacy issues as the business grew. So, for example, most of the leases were not all in one entity, and the employees, again, were spread over different entities, but mainly in one. And equipment hire agreements were in another entity. The business turned over approximately $12 million each year. Most of its venues were profitable, but some were not. And crucially, it had accumulated tax debt, including superannuation guarantee charge liabilities of approximately $2.5 million. Most other creditors were generally paid up to date. The tax office eventually lost patience with the company's directors, and it issued director penalty notices, which meant that the directors either had to pay the outstanding liabilities in full, which wasn't possible, or they had to appoint a liquidator or administrator to the companies within 21 days of the date of the notice. I was then appointed administrator to the companies, and as I continued to trade the business, I also exited 2 loss-making restaurants in New South Wales and 1 in Queensland. This left venues only in Victoria and Western Australia, which were the business's key markets. Staff in those venues that closed had their employment terminated, and there were also some terminations of non-core middle management. The main director put forward a deed of company arrangement, or DOCA, which essentially was a promise to pay on average $40,000 each month to a deed fund for 21 months, which was estimated to be enough to pay all administration costs, the unpaid superannuation owed to staff, and all unpaid annual leave and retrenchment entitlements to the staff that had been terminated. So the deal was $40,000 a month, which is slightly different to what's on the slide there. The DOCA proposal was accepted by creditors as the alternative, in other words, liquidation, meant all staff would be terminated, and the return to employees for their unpaid superannuation would have been far less, if anything. As a result, the business was handed back to the company's director. 101 employees kept their jobs and 16 landlords kept their tenants. The business came through the process more profitable, more efficient, focused on its key markets, and effectively it had agreed to pay $840,000 in total over nearly 2 years, as opposed to $2.5 million immediately to the tax office. And by paying the outstanding superannuation, the company's directors also avoided personal liability for that company debt. And now we're going to look at what are the steps you need to take if a restructure isn't possible and you want to close your business down. And I'll hand over to Andy.
Thanks, Henry. So if you've decided to close down, the steps that you take will depend on a number of factors and questions that you need to ask yourself. The first question is, what is your business's structure? You need to understand that structure, i.e., is it a sole tradership, or is it a partnership, or is it a corporate entity or a corporate group? Because if it's something like a sole trader, that business can't be handed over to an external administrator like Henry or Louisa or liquidator to be dealt with. So it's important to know exactly what your structure is before you go into that. The next question is it solvent? Can your business pay all of its debts if it's going to close down and when it closes down? There can be solvent and insolvent wind downs, so it's important to note that. It's also important to note that if you do terminate a business and you, by doing that, you terminate a lease, that could trigger a big liability in itself. So something to keep in mind is get ahead of it. Talk to your landlord and see if you can agree terms that will reduce that liability if you walk away. What creditors do you have, and what's your personal exposure to those debts? Henry will now talk about the possible options at the bottom of the slide that are dependent on exactly how you answer those questions.
Yeah, thanks, Andy. So, as you say, depending on the answers to the questions and issues raised by Andy, there are probably 3 alternatives to closing down the business. Firstly, if the business is solvent, in other words, it has sufficient cash to pay all of its liabilities or access to that cash, it can, of course, cease trading, terminate staff, terminate any leases, and pay all associated liabilities. If the business is traded through a company, it could then either deregister the company or voluntarily have it wound up using a member's voluntary liquidation, which is a straightforward and relatively cheap process if all tax lodgements are up to date and the company's creditors have been paid in full. If, however, the company is insolvent, in other words, it can't pay all of its liabilities, then the company should be placed into liquidation. This is done with the approval of the company's directors and shareholders. The liquidator will then sell any remaining assets, collect any amounts due to the company, and distribute any available funds to the company's creditors according to the priorities set out in the Corporations Act. The business operator may choose to shut down the business prior to appointing the liquidator, or leave it to the liquidator themselves to terminate staff, disclaim leases, and deal with any other contracts the company has. There's also now a simplified liquidation process that can be followed, which entails less work by the liquidator and therefore, in theory, maximises the prospects of amounts being paid to the company's creditors. The eligibility criteria are the same as that for those of a small business restructure generally. And the main criteria, again, are that creditors are collectively owed no more than $1 million, all tax lodgements are up to date, all employee entitlements, including superannuation, that are owing are paid up to date, and that the companies and directors involved have not previously been through this process or the small business restructure process within the last 7 years. Okay, we'll now move on to the next slide where Louisa will consider asset protection.
Thanks, Henry. All right, so regardless of what decision you end up making for your own unique set of facts, circumstances, and situation, asset protection is a topic that applies to everybody. So asset protection is asking yourself if your personal assets are at risk if the business doesn't work out. So the main thing that people care about with asset protection is my family home at risk if things don't work out with the business? So in order to unwind this question, here are some of the few factors to consider. So can creditors of the business ask you personally for payment of the company's debts? So in particular, the big ones are landlords, the tax office, and anybody who you might have signed a personal guarantee to. So let me unpack this a little bit. So if your business is in a company structure, which for a lot of people it is, not everybody, but for a lot of people it is, the law recognizes the company as separately from you as the individual, as the director or shareholder of the company. So you're considered two separate legal entities from a debt point of view or the law's point of view. So certain debts might accumulate in the company and they're the company's debts. And the problem is with the company if the company can't pay them. I think I've said the word company enough. But you, as the director, do you ever end up being responsible for the company's debts? And that's the important question to answer, because the answer is sometimes yes. Now, sometimes people are fully aware that they're taking on this risk and obligation of being liable for some of the company's debts. But other times, many times, we're not aware. And this is something to look into and check your contracts for to work out. So say, for example, with landlords. I don't know if you remember, but when you signed your lease, there were all these sign here stickers or little crosses down the page. And we dutifully signed everywhere there was a sign here sticker. Now, some of these will have been you signing as, say, the director of the company, saying that the company enters into this lease with the landlord. But in some circumstances, there might be in the lease some places where you sign in your own right as an individual saying, you know what, and if the company can't pay this debt to you, landlord, I personally will pay it to you. Now, a lot of the time, we don't realize that's what we've signed. So it's definitely worth going back and having a look. So you're looking for things like the words guarantee or guarantor or personal guarantee or personal guarantor. Sometimes if you have specifically negotiated this away, then that won't be in there. But odds are if you haven't specifically negotiated it away, you might have ended up personally liable for anything, any unpaid rent on this lease. In relation to tax, Tax is an interesting one because in recent years, the tax office has brought in provisions that say if the company doesn't pay their PAYG withholding, their net GST, and their super on time, then the director can become personally liable for these three types of debts. So again, that's PAYG withholding, net GST, and super. Now, many people balk at this because that's usually quite a high amount, and it's sometimes one of the last amounts to get paid if we're struggling for cash flow. So in order for the tax office to claim it against you personally as a director, they first have to issue you what's called a director penalty notice, or a DPN. Now, if you get one of these in the mail, I highly recommend you ring somebody urgently right away. Our contact details will be on the last slide and circulated and all those sorts of things, because that is a very urgent and important legal notice. And as far as possible, you do not want that liability to attach to you personally. So again, that's a director penalty notice, and think of it as a big red flag, and a super urgent phone call needs to be made. Now, depending on how you've gone with your lodgements with the ATO up to date, that will depend on if you can get out of the director penalty notice. So with PAYG withholding and net GST, if you have done your lodgements within 3 months of the due date of those taxes, then you can put your company into liquidation of voluntary administration and no longer be personally liable for the company's debts. But if you've left your lodgements to be past 3 months, so older than 3 months after the debt is due, then the only way you can get out of that director penalty notice is to pay it. But of course, if you could have paid it in the first place, you wouldn't be in this situation now, which means then all of a sudden, all your personal assets, so family, home, anything in your personal name really, is now at risk of being, or high risk of being lost. So the lesson out of that is, even if you can't pay the debt right away, get your lodgements in either on time or for PAYG withholding and net GST within 3 months of it being due, because that leaves you more options down the road if things aren't going to work out. Now, with superannuation, of course, we pay this to the employee super funds, but if we're running late, some of you may have realized that the ATO comes to collect on behalf of the employee super fund. Now, with super, this needs to be reported by the due date. So with PAYG withholding and net GST, you can report within 3 months of the due date, but super, you have to report by the due date. Then that way, if you're ever issued a director penalty notice, you can put the company into liquidation and voluntary administration and no longer be liable. But if you report your super late, the only way to get out of that is to pay it. So that's quite an important consequence. So that's the element of tax and how it might affect you. All right. Personal guarantees. Personal guarantees are any agreement where you have said, I, as an individual, will pay the company's debts if it doesn't pay. So we saw an example earlier with the landlord. We also sometimes see this in supplier accounts, especially the larger suppliers, but not necessarily, in some of the small ones as well. And we also see this with financing arrangements. So if you have kitchen equipment finance, if you have motor vehicle finance through the company, sometimes even though it's in the company's name, they ask the director to say, if the company doesn't pay, that I'll pay personally. So these are all risk things to check to see to what extent any assets you have personally might be at risk. Another element to watch is sometimes as directors, we put things on our personal credit cards or even corporate credit cards, or take out personal loans or redraw our home loan in order to keep our business afloat. We do this because we care about our business. We didn't get in this just to pile up debts that we can't pay. That wasn't our intention. But what happens is, because some of those loans and debts are in our name personally, even if the company has to go into liquidation, that doesn't remove the fact that the borrower, so to speak, or the credit card liability sits with us. even if we use the funds for the business, the bank or whoever has recognized that the card's in our name. And even with corporate credit cards, this can stay in our name. So lots of things to think about there, because we don't think about these things as we go along when things are going fine. But if things go poorly, then these all become very critical questions. Also, should you take security if you're lending your business money? Now, this one I've put on there because it's an issue about, do you have better chances of getting repaid if things don't work out? But it's really one that needs to be discussed one-on-one, because there's so many different situations. But I just wanted it there on the slide so people remember if they ever look back on the slides. Another thing to consider is company structure. If you are in a company, are you all in one company, as in are your assets in the same company as your employee liabilities and debts? Or like the example Henry said before, is it across different entities in a group? Is one the employing entity? Is one the entity that holds, the intellectual property? What does that look like, and can it be improved? Also, who are the directors? Are there more directors in the company than there needs to be at the moment? Because sometimes all directors get asked to sign personal guarantees. And especially say in a husband-wife or like a family partner type situation, do both need to be directors? Can it be one? Because maybe the assets are in the other partner or spouse's name. So lots of things to consider there. This is all definitely leading towards a discussion for people's unique situations, obviously, but just wanted to give you guys a bit of a flavor about the things to consider there. All right. One of the other things which people commonly ask is, so if we help you, how does that look? Which is a totally valid question. So some of the things that are important to us to make sure people hear and understand is that we're understanding in our approach, and we're non-judgmental. It doesn't matter if people have arrived here through things entirely not their fault, COVID-19, or if for whatever reason it was our own decisions that led to this point, and things that we thought would work didn't really work out. So to a large degree, we don't care. It's not important. What's important is helping you now, wherever you're at. We're very thorough in the way we prepare, because if we're putting any strategy or plan in place, we want to make sure that there's no surprises through that process, because whoever's going through this is usually stressed enough where they don't need any more stress of uncertainty or surprises through the process. So we're very careful about that. And it means that we'll do more work up front than most other people, but we want people to go through this well and smoothly. Excellence and integrity, doing things to a very high standard, is important to us. And integrity, we will work to the utmost professional and ethical standards. Co-creation and co-execution of strategy. Now, this is if desired. And the reason it says that is some business owners and groups want to be very involved in how their business can be reshaped and saved. So, for example, the example Henry gave, that's one where it's working closely with the director to come up with a plan of what the business can pay. And it doesn't always have to be $40,000 a month, by the way. It can be a lot less. Sometimes it's more, depends on the situation. Sometimes they want to be involved in how this can be fixed and reshaped, and we'll contribute our expertise about processes and options that might be available, and they'll contribute their knowledge about the business because they will know that way better than us. But other times, especially say if it's a close down, people have quite genuinely had enough and say, Louisa, Henry, Andrew, would you just please take care of this for me? And that's totally fine too. Discretion and confidentiality, everything is very much confidential. So anytime people meet with us, the first meeting is completely free, no obligation if you never want to talk to us again or anything like that. And discretion and confidentiality, nobody needs to know that you've come to have a chat and find out some more. And we're a house of experts. We do lots of different things. So if there's ever a need for supplementary type professional services, we can help there too. All right, so this is us. You met us at the beginning. I'm Louisa Siderbat. You've heard from Henry McKenna and Andrew Whitaker as well. Oh, a couple of other things. So here at Vincents, we're located many places around Australia. Physically, we're located in Sydney, and we have a very big representation in Brisbane and Queensland as well. We're the 28th largest accounting firm in all of Australia, according to the Australian Financial Review. And we've been a finalist in the Client Choice Awards 3 years running, and then some. I believe it goes older as well, but we just put the last 3 up there. So we've helped many people through these situations before and got some really good results for people. All right, so I believe there's some questions. Let me pop into the chat, and would any of my team like to read me the questions, and we'll give a go at answering them.
Yep. So we've got a question here, and it is with regard to lodging super and PAYG on time in order to avoid becoming personally liable and being served a DPN. Is there a time limit involved with this? For example, if you've lodged on time for the last 24 months, etc., or is it for the entire past lifetime of the company?
That's a great question. And the answer to this is that there are some time limits as to when it's from when these laws came in. I honestly can't remember off the top of my head when the laws actually came in. It's in the last, if I had to guess, maybe 1 to 3 years or so, maybe a little bit longer. I can see who the questioner is. So hopefully that can be tied to an email address, and we can send you a detailed answer after this as well. It's not for the whole history of the company, unless the company is very, very new in the last few years, by the way.
I think the thing to add to that, Louisa, is that you've actually got the lodgement can be done up to 3 months after when it was due to avoid the liability under the DPN as well.
Yeah.
So it might have a due date. So as long as you get it in within 3 months of that due date, you still avoid the personal liability.
Yes. And a very kind, knowledgeable person who I know who's on the webinar has reminded me that the GST personal liability comes in from April 2020. So it's reasonably recent, which is good for many companies. I've seen another question come through. What is the ATO's approach to current debts that have not been able to be paid off during COVID? Debts remain similar balance to 16 months ago, so business has been paying the current amount. That's a really good question as well. The ATO is being the nicest I've ever seen them be. They're taking an approach which I believe in their own words is considered supportive and helpful. A key thing for the ATO is they want to see engagement with them. So to try and get on a payment plan of sorts. The payment plans they're offering at the moment are some of the most quote unquote generous, so to speak, or at least long term that I've seen them offer. They didn't used to offer this kind of payment plans pre-COVID. Pre-COVID, they'd want, everything paid in 6 months with, 50% upfront, which, for most businesses is like impossible. But now I'm hearing of the ATO accepting payment plans over a few years, which was unheard of before. So what they want is engagement. They want you to talk to them. They want you to go on a payment plan rather than just disengage. So they're more likely to issue you a director penalty notice if you don't have a payment plan but have a debt with them. So give them a ring. Sometimes it's just like an auto, almost like robocall, insert, what you want to pay each week. And, the machine goes, yes, that is accepted. It's like, oh, I didn't even talk to a human. So give it a go. Keyword is engagement. All right. I think that's all the main questions there.
There was a comment in there that would have been private, so I don't think the rest of the people would have seen it, which is basically, hi Louisa, I would probably mention caveatable interests under personal guarantees. I see more and more contracts having this clause.
Do you want to talk to that one, Henry, or would you like me to?
I'll leave it to you because that's the asset protection stuff.
All right, sure thing. So what that person is commenting on is, you know, when I was talking before about how sometimes whoever we're borrowing money from, whether it's credit accounts or, you know, landlords or whoever we owe money to, want us as directors to be personally liable for the company's debts. What this person is saying is that in addition to just being liable for their debts, this person is seeing the creditors taking a formal legal claim over somebody's home to ensure that they pay those debts. So that's quite a big move. And yes, I probably should have mentioned that before. So it can really encroach upon our own situation financially, separate from the company, even though they start off as separate legal entities. So thank you very much for contributing that. You know who you are. Another question, given the ups and downs of lockdown due to opening and reopening, how can one go onto a payment plan? This is a super valid question because this is literally life right now. What the ATO want is some kind of payment plan. So if just say, and this is so hard because we don't know what our cash flow is going to be because we don't know when lockdown will lift or what the rules are. The rules change at a drop of a hat. We get no warning. What I'd recommend is staying in touch with the ATO. Pick a payment plan that is not super aggressive and see if it's something they'll agree to. And then if there's a lockdown, get in touch with them and say, can I put payments on pause and, you know, for the period of the lockdown because we're not trading, or I'm down to 30% trade. Can I pay 30% of my installments? And keep them in the loop for the conversation. It's not an easy situation to be in, but what the ATO want is for us to talk to them and not ignore the fact that we have tax debt. All right. Well, in my haste to jump into the start of this presentation, I totally forgot to ask Wes from Restaurant and Catering Industry Association to introduce us and to introduce Vincents, because we're a new partner of the Restaurant and Catering Industry Association. So, Wes, if I could just ask you to do a brief intro, we're a bit reverse order at the moment. We'd really love to hear what you're seeing in the market and your industry update, because your finger is right on the pulse. You're at the forefront leading advocacy for the restaurant and catering industry, which we're very grateful for. So we'd love to hear what you're seeing.
So thank you so much, Louisa, Henry, and Andrew, for organizing this webinar and for the at least 140 people. That's a great number of people that are joining us to hear this very relevant information. Restaurant and Catering and Vincents have recently entered into a partnership, which we absolutely appreciate and are looking forward to fleshing out to all of the wonderful things that we are able to do together, and certainly providing our members and everyone with insolvency and restructuring and advisory advice into the future. So on to a market update so that we can stay on time for the webinar. Well, for many of you, about 64% of restaurants, cafes, and caterers are presently in lockdown. And certainly this is not good for your businesses. So I will do a quick around the country market update. So New South Wales, where we are right now, is in lockdown and expects to be so until the state reaches 70 to 80% vaccination. However, we do expect that the Premier on Thursday morning will announce some easing of restrictions for September. Hopefully there'll be some hospitality in that. Victoria is in a similar situation, also considering staying locked down until its state gets to 70 to 80%. Not necessarily indicating that publicly yet, but we do expect that as the case numbers stay peskily in the 40 to 50 to 60 range in that state, that it may also drag out to that 70 to 80% before it fully reopens. But it did have a roadmap in 2020 that did include some predominantly outdoor dining as it worked on reducing its case numbers. ACT, as it is fully encompassed by New South Wales, is also in lockdown at the moment, and we do expect that it will stay so for the foreseeable future. Brisbane and Queensland right now, there are 2 cases in Queensland, in the Brisbane area of concern, but we are hoping that Queensland stays out of lockdown. South Australia is out, Tasmania is out, NT is out, and WA is out. How this affects the hospitality industry is that pre-COVID, about 36% of meals were eaten out of home. Now, that's a huge percentage. It's one of the highest in the world. So it is super important that those hospitality businesses are allowed to trade, because it is a Australian thing to do, to dine out. It is Australians have an amazing dining out culture. So according to IBIS World, which we rely on for a lot of revenue information because the ABS just takes too long, has indicated that the hospitality industry, since the beginning of COVID, has dropped $10 billion in revenue. Now, that's a huge amount. And that means that for the approximately 48,000 restaurants, cafes, and caterers, to lose $10 billion means that some of you certainly may be at the wall in terms of operating your businesses. And those of you who did make it through 2020 and into early 2021 may be finding yourself in a different situation now that there is no JobKeeper, that there are no insolvency protections, and that the disaster relief payment that goes to your stood down employees is not coming through your business. Many states and territories do have grants that get re-upped usually every time an extension is announced for the lockdown in that state, if all that is available is grants. And then in New South Wales, there is JobSaver, which is a weekly payment that would be coming to your business. One thing to note that even when you're not operating, meaning if you still have a premise, you still have an active lease, but you are not allowed to trade because of lockdowns or because you just didn't do takeaway and delivery before COVID or before this latest lockdown, you still are eligible to apply for those business grants and for JobSaver and any available government funds. They are activated on pre-lockdown payrolls and trading, and certainly the government in New South Wales and Victoria and ACT would not want you to be trading in unsafe environments when the case numbers are so high. So what is the future of hospitality? Well, it certainly will not ever look like it did pre-COVID. We do expect that even when we get to that 70 and 80% vaccination rate, according to the Doherty Institute and their report, that we could go back to a pre-lockdown or pre-COVID level of trading. However, in the asterisks in the bottom of the document, and really coming from almost every premier and the federal government, that there will be some restrictions that remain in place, which could mean masks, it could mean social distancing, and it could mean some density restrictions. So we do expect that even when the magic numbers of 70 and 80% are achieved, that our industry will remain with some restrictions until the governments and the chief health officers see how being 80% vaccinated and potentially into the future with booster shots affects the hospitalization rates and the ICU and mortality. So ultimately, we do know that things may continue to be difficult in the industry. We will continue to advocate for the industry. And certainly we're seeing green shoots around the country. In the recent MasterCard Spending Pulse report that was quoted in the media today, food retailing is down just 1.2% in July from the previous period. So certainly something to look forward to, that many of your businesses have pivoted back into that takeaway and delivery and retail. We do expect that August and September may be down further than that 1.2% as the lockdowns continue to extend and many more areas in New South Wales were sent into lockdown and also Victoria. But we will continue to be here, Restaurant and Catering, and Vincents will, as our new partner, will continue to be there for you to ensure that your business survives. There are many options, as they described earlier in their presentation. There are deed of company arrangements, DACAs. Certainly, this is a time when, because of the landlord code of practice that's been re-implemented in New South Wales and Victoria, if you need to walk away from your lease and move your brand somewhere else, certainly options. Don't despair. There are ways for you to either continue to trade your existing operations, close down, and potentially move into something else, or move your brand. And we certainly are always available here at Restaurant and Catering to answer your questions and to put you in contact with the right partners of Restaurant and Catering, like Vincents, for you to get the advice you need. And if you're not a member of Restaurant and Catering yet, you are more than welcome to visit our website, www.rca.asn.au, and you will be able to get relevant information in your state in order to join and to benefit from all that Restaurant and Catering has to offer, and to ensure that you have a voice to state and federal government. Thank you.
Thank you very much, Wes. That is a lot of information and insight packed into one go. We're very grateful that you would share with us and the members what you're seeing. All right, so that brings us to the end of our information session today. We will circulate the slides as well as a summary of the slides. It will have our contact details on there because each of you is in a unique situation. So what is the best option for each of you will be different, and it will be different from the business next door as well. So if you want to reach out and speak to us, please do. We're not scary. We hope we've shown that today. And any first consultation and sometimes beyond is completely free. We want to be there to help you guys. We understand what it's like for it to be a very stressful time. Personally, probably over 10 years ago now, I've had to put a company of my own into liquidation. I know what it feels like, and it can be ridiculously stressful, just the unknown. So we want to break that down and equip you guys with that knowledge and take away the scary factor, because you guys are smart, savvy people. You wouldn't be business owners if you weren't. And we believe that you can make good decisions. So we want to help you along in that process. All right. I have seen some very, very late questions come through. I am very sorry that we're out of time. If we can still trace them, we will reply to you. Although if we don't, it might be because the webinar software doesn't let us see your contact details. But please, when we circulate the slides, please write back to us if there's a question that that came through late and we didn't answer, or if you have any other question. We want to help you guys out. So thank you very much for coming along. We hope it's been helpful. Thank you very much, Wes, for sharing and spending your time to invest in these people. And thank you to my team as well for putting this together. We hope it's been helpful to you all. Thank you. See you.
Thanks.